Well, let's get started then. We're very happy to have Margaret Holen talk to us about math and money, careers in finance.
Well, it's a pleasure to be here. It's always strikingly beautiful to come, although even when it's a cloudy day, right? In some ways, the sun always shines in this very special place. So math and money, careers in finance, but no matter whether you work in finance or not, right? We all kind of have to worry about it, right? So I wanted first to talk about what financial services is, right? Where do we all see it? Why does it come up in our lives? And how do the companies, when you think about a lot of people who go into mathematical sciences, right? And then end up working in finance, what is it that they do there, right? What pulls them, what calls to them? And what are some of the, how does that relate to how we experience and interact with financial systems every day? So, and then I'll give a sort of very brief introduction to the mathematics of finance, very high level. And I just say there, I know some of you are investigating adjacent areas, your research may be adjacent, some of your outside interests may be adjacent, and that section is very high level, and I'm happy to leave a lot of time for questions if you want to ask about certain aspects of application of machine learning. I am certainly not an expert everywhere, but I've worked kind of around a few areas and a few different neighborhoods, so I'm happy in that section during the talk or afterwards, to talk more specifically, talk about some deeper technical stuff if anyone wants to go in that direction. And then finally, I'll talk about careers, kind of my career, what yours might be in years to come. So here's just my abstract of the talk. And here I just wanted to highlight sort of the trajectory again, like that we look at finance choices every day. And this is an industry that has lots for all of you in the mathematical sciences to do, both to help deliver an incredibly complex suite of activities that are sort of chugging along even as I speak, right? And to advance and change how those activities happen. I want to sort of inspire you to think about how your math background can help you understand what the system as we interact with it and what it means to be a citizen. This is a regulated sector. This is a sector that works in trust and in the commons, and whether or not you're working in it, we're all working with it. And what do we want it to be, right? What does it mean that we all have mathematical training and therefore and interest in the mathematical sciences, and how can we use that interest to be more informed as citizens and as consumers who can also shape the future of this industry. But first, I'd love to just ask a little bit about all of you. So how many people are based kind of in this New York area and come from close by? So and then how many traveled from like another coast or another continent? All right, so another like good, right? So I guess and how many like from the middle, like not quite here and not quite here? Okay, so that's like about a third. That's a pretty good distribution. So that's, how many of you are grad students now? Okay, so it looks like most of the conference attendees are graduate students, and kind of earlier, later, anyone want to just all towards the end? How many towards the end, like looking towards the end of the barrel of graduate school, as it were, right? End of the journey. And then others, okay. And middle? Okay. Anyone right at the beginning? Okay, all right, so also a little bit, but of course, right, I know I was a grad student too. You don't always know where you are in that journey. And fields, how many of you would describe yourselves as kind of the more pure side of math? All right, so that's like, I mean, we know these lines, right? And I'll talk about different ways of thinking about a sector, right? And different ontologies, right? And We know there are many, right? We don't have strict borders. And then how many of you would say I am definitely kind of more applied or in an engineering side of math skills? Okay, so then some overlap, but a little bit more on the pure side. So great, that gives me a sense of where you guys are. And so this is just a bit about me and where I came from. So I was in the math, I did my undergrad, I grew up in Washington, DC. The seat of government. I think that does change my perspective a little bit, right? So I knew people growing up who were involved in a lot of different industries. They were often involved in policy or in governing in some way or in regulation. And I really thought when I was very young that I would grow up to be a lawyer, that was kind of the scaffolding, that was kind of the pattern underlying a lot of what people did in the world. Was how we got to sort of communal consensus through government. But I went off to the University of Chicago, kind of ran away, and it's sort of a history of doing that to a place that not a lot of people from my high school went, at the time, University of Chicago. It sort of has a different vibe now, maybe, and loved math, really got in sourceful, just analysis, I felt like it was so beautiful and it gave me transformative ways of understanding the world. And I went on to do a master's at Oxford, and which I enjoyed tremendously, and just the physical beauty of that place made it sort of such a great delight. And then came back over to Fine Hall at Princeton for my PhD, which I will tell you was a tough time for me. I had graduate school was not a place that I felt that I had kind of found my calling. But I was sort of determined to finish, and I did. And then again, I sort of felt like I was running away to Wall Street. And so I went to New York, and I'll talk a little bit about more what I've gotten into. I spent about a couple decades, let's call it, rounding, right? In corporate careers at investment banks. And then I've gone on to work with smaller companies, to work with investing in startups, and now involved with board and governance at some slightly larger companies, and continue to then come back to Princeton, and enjoyed teaching in about at the intersection of math and financial engineering in the Orphy department here. So that's a little bit about my journey. And let's then talk about where I ran away to, right? The financial services. This is New York. It was built on a grid, but this is the downtown. That's the, down there is the Customs House. So one of the older buildings in that downtown area, and it's a place, good, built on a grid, but lots of wobbly streets down there. And but that's where I was working not too far from there when I left this environment. And so what did I find there? What is finance? A lot of what happens inside those big buildings is finance, right? It seems mysterious, it seems obscure, you can't see through what's going on. So let's take a peek in, right? So let's start, right? Most of your theories, so it's got like a start or more pure. So let's start with something foundational. When we think about money, what do we think money really is, right? If you're talking about finance, it's the business of money, right? So what do we use money for, right? As sort of the abstract of talk started, like if you bought a coffee this morning, which I guess we're at the Institute, you have these magic cards, but when you do, when you're at maybe traveling back, they'll ask you, how do you want to pay, right? It's a medium of exchange. And oftentimes, and you can still pay with cash, right? And, but it's not just a medium of exchange, right? It's a store of value. It's some sense that we think reliably, if I go to buy a coffee tomorrow or in a year, the price isn't going to be radically different. Now we're recently have seen prices go up, right? But, by 10%, right? Like, so and then lastly, money also gets used as a unit of account. So tracking what happened. So you didn't pay for coffee this morning at the Institute, but they're keeping track of someone paid on your, there was an NSF-funded conference, right? Money came in from the NSF, and some portion of that went to the dining hall, and they decided what they would do. They're keeping a budget that includes a line for coffee purchases, and that generally will be kept in units of currency, right? Dollars, and units of account then become, these are sort of three that we're not just storing value, that we're even just keeping track of value using these units. When we think about those high theoretical questions, right, as I've already been saying, we can then relate back to just these questions we have every day and the way that we all are used to interacting with the financial system, right? So you're asked now all the time, do you want to pay with cash or credit or debit? Isn't it crazy? With credit, what does that mean? Someone will lend you money to buy you your coffee, right? Maybe, right? That's and when you buy things online now, increasingly, right? So I certainly make a lot of my purchases online. I'm asked, you could spend $54 today, or you could pay, $18 a month at 0% APR for, that's, wow, I have to ask a question about my preference for payment sooner rather than later, right? So I'm making a decision about money over time. To some extent, someone's willing to transfer value to me. They're willing to take value from me up front for that purchase, or they're willing to take it over time. Then we get to some bigger decisions. And when I buy a car, do you pay from savings that you've accumulated in an account, right? We talked about units of account. That's both because you're storing value at a bank, right? And then you're tracking it in dollars, or you're going to take a loan for that. Most car purchases are made on credit. When you go to school, right? There's been a lot in the papers on student debt, right? That's a capital investment in your human capital, that you're going to get trained, you're going to get experience, you're going to get credentials, sort of third-party credentials, right? And a lot of that is funded with loans. You get the value, you expect to realize the value of that over time, and someone will lend you money for that. And then there are other decisions you're going to have. Are you going to open for those? Most of you are grad school, but some of you have started postdocs or jobs, and you have to think, do you want to open a retirement account, right? If you're saving money from your graduate school stipend, what do you do with it? Are you going to save it for later? And then you also have issues of life insurance, health insurance, right? Uncertainty. So basically, the business of finance is moving, it's money to exchange, and then moving money in time and pooling risks, right? I don't know if I'm going to have a car crash, but I'm going to pay, we're all required to, right? In order to drive, generally, you're required to have, if someone's going to let you drive, you're required to carry auto insurance to pool the risk of accidents. So even if hopefully none of us, I was glad not to have one today on my way, right? But we have pooled risk. So when we think about finance from a consumer view, you can think about kind of these four segments that I just talked about: payments, exchanging, saving, investing, borrowing, and insuring risk. So means of exchange, means of moving money in time. I can have money today, I don't need it, I want to put it somewhere and have it later. I can borrow, I would rather not spend the money today, I'd rather wait, I'd rather not pay the tuition today, I will take a loan and I will pay over time. And then insuring and pooling risks. And each of these segments, right, has a large, represents a lot of business activity and a lot of career paths. But let's just think about what they do how they function in the world and the end goals they serve. Payments, we have underneath the hood of payments, a lot of different types of businesses. We have cash managed by the government. Increasingly, we hear about Bitcoin, and some of this framework for what is money comes from a great talk, that I find quite compelling by the former head of the Bank of England, whose name is Mark Carney, who's very involved with some financial sector, different climate initiatives now. But he's bringing up these points and really considering whether cryptocurrency or non-fiat, non-government managed currencies will become what we think of as sort of commonly used forms of money. And right now, most of the money that we exchange, for the most part, when you have cash, the cash will be managed by whatever government is, if we're in the US, it'll be the US government, but by whatever government is the national government of, or in the European Union, of course, the multi-government agency that manages money, and it would be called fiat money, right? It has some exclusive rights and privileges. Underneath the hood, if we're asked to pay on credit, we're using a payment network. Sometimes when we're paying online, the end service on top of that payment network is provided by an electronic payment services company. And then there are specialist services companies that focus on remittances across jurisdictions, which can be especially complex because so much of money is managed by governments. You're like, wow, all I'm doing is paying. And already there are lots of different types of companies potentially involved, right? In something as simple as payments. And then let's think about borrowing and saving. Sort of think of those as two activities, so like really separate, right? I either have them, if I have a big purchase I need to make and I don't have the money, I'll borrow. And if I have money and I want to deposit it and I want to quote unquote save it, I would in either case go to a bank. And what does a bank do? Generally, or the business I'm most likely or have traditionally been most likely to go to is a bank. A bank is an aggregator. A bank succeeds because they get many of us to come in and deposit our savings, right? And so they accumulate lots of deposits, which really represent IOUs to me, right? I bring my money to the bank and I want to go back and then they owe me. When I want the money back, I'm effectively lending to the bank. And then in turn, if I need to borrow or if I want to start a company and in order to buy inventory, right, I might want to take out a loan, right? So these borrowers can be individuals or can be communal entities. I also go to a bank. And why wouldn't I just go to you or to an individual and say, can I borrow? Well, sometimes I do. That's informal finance. That those personal networks work, but banks work at very large scale and then become diversifiers of risk. And banks also tend to be special because they are chartered. So finance banks certainly in many jurisdictions, including the US, are really special. I could set up as a business and register locally and get special legal status to take on a contract, not as an individual, but in the name of a business entity. But if I want to open a bank and do business and take your deposits, I need to get really special licensing. I need to get a charter, which means I am supposed to be around forever. So this whole notion that sort of finance is complex, it's sort of special. And there have been special rules from very early times that distinguish banks from other types of institutions. And there were many types of payments business. There are a lot of different flavors of banks that vary by business model, but also vary by who they register with and who is overseeing their promises to run their institutions so they're safe and inspire confidence of savers. So you have your national banks, your online banks, your credit unions, your community banks, what you think of as neobanks that have started more recently and have more of an online-based business model. But no matter what, generally a bank will require a sort of special status and a special charter. Although increasingly you can go get a loan from something that isn't a bank. It's a specialist lender. They're often called fintech lenders. And these are lots of, terms of art and it's a big industry, lots of special words, but what's a fintech lender? It's a lender that says, look, I can go out and start making loans. I don't need to accept deposits. I can be here for you as a business just to make you loans. And I'm going to find some other provider of lending capital other than I don't need to ask for your savings and lend it back to you. I'm going to go through a market and find an investor who has extra savings. Maybe that's the Institute for Advanced Study, which has a large endowment and allocates that endowment to a lot of different kinds of investment products, which could include startup companies that are going to lend. And one of those funding you was one that I invested in, and and sort of inspired my interest in a lot of I'll talk about later today. And a lot of fintech lenders that start up, right, they don't have these institutional promises to savers. They can go out and get capital from more adventurous investors. Why are the investors more adventurous? Because they can afford, they both hope to get greater gains, but they can potentially afford higher failure rates. And so a lot of these fintech lenders are using kind of new approaches to lending. So 9 out of 10 in the US, and a lot of things in finance, again, do depend on what country you're in, to some extent, sometimes even what state or you're in within the country, but they vary a lot. So a lot of what I'll talk about is US based, and I know about some other jurisdictions, but a lot of fintech lenders will use kind of every 9 out of 10 consumers in the US has a data file about them at a credit bureau, which means that they've had some contact with lending. They've used they're an authorized user on someone's credit card. I mean, it's both on the one hand, some government agencies say 1 out of 10 don't, and that's a problem, but wow, 9 out of 10 do, right? That's a lot of data about the history of paying back loans. What does it mean if you haven't borrowed before and you want to start? How do you start? If everyone wants to look at your history, but maybe you don't have history, tricky. All right, that's been problematic, tremendously problematic in the US, especially because through the mid 70s, and there was a lot of sort of very systemic exclusion from credit granting. And we're still, so what does it mean? There are a lot of new companies that start saying, we want to look at different types of data. We want to look at how much money you have or how much income you have. That's pedal. You're taking a student loan. What's going to happen to you in the future will depend on what you're majoring in, how well you do, understanding the human capital you're accumulating, and what you can do with that. So these are companies that say you are more than that credit file. It happens a lot in these sort of newer companies that can, again, take more risk to start new ways of doing business. If we step back and say, what enables that? Let's take another view. If you're saying, I want to be one of the people who starts one of those companies, I want to think now about financial services, not just from the point of view of myself as an individual, but as myself as potentially someone who's going to start a business. How might we look at the world? Well, here's one way, and again, and imperfect, hopefully useful. Some things we talk about, poor payments. I put saving and borrowing together now because those are often managed by banks. I put investing in a separate category, asset managers and hedge funds, also endowments and foundations. Ensuring risk is still there. Here we have something new, markets, right? Would connect institutions that are accumulating assets for the future. Those would include also, think about insurance companies. You pay in your premium and you need a payout if and when you have an accident or you have a health problem, or if you have life insurance, so it's over a much longer period of time, right? In the event that, or long-term care insurance, right? You will need to pay out potentially much longer in the future. In the meantime, what does the insurance company do with the premium we paid in? It invests through the intermediary of markets. So markets sort of sit in the middle, and markets enable a lot of specialization. So as we're saying, markets can connect an investor with a new fintech lender and help that fintech lender provide capital for new types of borrowers. Or maybe with an operating business like the fintech lender that I was talking about funding you. So then there's also a huge amount of, I have this other information and search. There's a lot of specialization here, and there's a lot of connections, and there's a lot of information, data about market prices, right? I mean, generally you probably see on the TV, the market did this today. Which market? For what? Oftentimes those are equity markets, right? There's a lot companies that are publishing accounts, right? Many levels of different types of data, many decisions being made as these businesses look for customers and these businesses match up to find, to meet each other's needs. So I left here, this is a lot of detail, just, and something that we can potentially come back to. You can look up later to say, wow, I mean, there are a lot of sectors I just gave. These are service types that I kind of said, what is this sector? What does that mean? What do they do? So investing, and I will highlight just that one row. A lot of, I would say, markets connect a lot. So if you think about things together, right, and aggregations, there are about, $50 trillion in equity markets. There are about, $15 trillion of mortgage debt, of individual borrowings. A lot of the capital, a lot of that flows through what we would call these markets. And as with payments, right, we pay for things every day. There's a lot more exchanging in markets than there necessarily is capital going from kind of one end saver to one end borrower. So there's a huge concentration of activity in markets, and a lot of those, a lot of that decision making happens in this line we called investing, and a lot happens in these markets. So I sort of put in markets the sort of place I went to work, where I worked. I worked at Goldman Sachs, I worked at Lehman Brothers. Those are what we would call investment banks. They work helping companies match off with each other if they have parts of themselves they want to sell, or if they want to find new types of investors, but then they also facilitate access to other markets, to stock markets. They will facilitate access between those fintech lenders and other borrowers. So in fact, Goldman Sachs lends money to Funding You, who in turn lends money to students based on their student records. And then there's another huge concentration in investing in asset managers and hedge funds and quantitative hedge funds. And there's some overlap. Am I investing in a quantitative strategy? If I'm buying and selling things every second, maybe I look like someone who's facilitating a market. I'm not really investing for a long term. I'm really buying from someone who wants to sell at this moment and selling to someone else who may want to buy and hold for a longer period of time. And I'm happy, this is a slide I'd say that I would come back to, right? All of the companies, so your service types, here is sort of more specialization, asset managers, hedge funds, pension funds. Some of those things you look at and be like, oh yeah, pension fund, of course. I have a pension from TIAA. CREF is a big provider for educational institutions, right? And some of these you might be like, what is that exactly, right? Happy to answer questions. I bet this more, to maybe plant some seeds for later. And then there are sort of examples of individual companies. Again, a big sector, a lot going on here. And a lot of these companies have really compelling ways for you to put your expertise potentially to use, but also potentially to be useful to you. A lot of these would be classified as finance companies, and some of them aren't. They're classified as technology services, like PayPal. I think of it as a payments company, but if you look at what it's publicly traded stock it's listed at, they will say technology services. So there's lots of overlap. One under information search, there are lots of companies selling data to other companies to help them make decisions, but you can also get really interesting information from those. S&P, FactSet, Moody's are some names I'd mention. Then there are the credit bureaus that we talked about that collect information about payment history, all of our payment history. We all probably in this room have credit bureau files, and it's worth knowing what they have on you and thinking about the implications of that system. And then there's information here for consumers. One that I find that I will mention because I find it to be a particularly high quality is Investopedia. Ultimately, it focuses on retail products and placements. That's how Investopedia supports itself through ads, but I find it to often provide very high quality information about lots of different topics in finance. So worth noting. Of course, editorial quality can vary over time, but always like to note it's always nice to see one that performs well. So another side of finance our policy, laws, and regulations. So I've already said, like, trust plays a special role in finance, and probably lots of you have seen the news about the big bankruptcy of FTX and how they're right. How many people have seen headlines on that? With a big crypto exchange, and how crypto didn't depend on trustworthy entities, but in markets where marketplaces naturally bring people together, right? You think about a marketplace in any town, right? Naturally, you need to come together to exchange, so you'll tend to get concentrations in single institutions. And you will tend to, and there's a sense that it's important to keep those end institutions safe. When we all want to come and exchange and trade, and I'll feel good about, I won't feel as good coming to a market if I'm not sure that the vendor I'm dealing with carries trustworthy products. We'll be there tomorrow, right? If I go to exchange things, often even online, I don't exchange them instantly. I have to send the currency I have and wait for something to come back. I still have settlers, so trust matters. And every country and every US state has finance-specific laws and regulations and regulators for banks and for insurance, for payments companies as well. So this is not an insignificant part of what keeps us together. Finance is sort of fundamentally, has elements of trust fundamentally at its core, right? I'm only going to pay insurance premium to a company that I know is going to be there to pay out the claims, and has to do that reputably in a variety of ways. In the US, insurance is generally regulated at the state level, but there's this national, these are sort of a handful of regulators: the Federal Reserve System, the Consumer Financial Protection Bureau, the Securities and Exchange Commission focused on stock markets, and the National Association for Insurance Regulators, which is dominantly done at the state level. So regulation will focus on individual institutions and their trustworthiness, right? You're not supposed to take your customer money and spend it on personal stuff, right? Set it aside. And if systemic risk, is there contagion between institutions? Market integrity, when you go and you invest your savings, do you feel you're getting full information about the company, right? Are you or is someone else unfairly going to hear in advance that something bad happened to that company and sold early, right? And then there's also a really important part of financial systems, which is access control. So anti-money laundering, sanctions enforcement, fraud of all sorts, right? Like there's a lot of fraud and theft where the money is, and identifying that accurately and protecting legitimate users from those who would take advantages is a very complex area. A lot of interesting graph theory to find money laundering networks and groups that try to come together and look like legitimate counterparts when they're not. So I think oftentimes when we think about what finance is, you think about someone going to a hedge fund or a trading floor. All of that is enabled by all of this. And whether or not you are deciding to go into this industry, you are electing people who are going to determine in part what sort of services you see and what sort of protections you get and what sort of hurdles you might need to navigate if you want to go in and create your own business and introduce novel practices. And so understanding this side of finance is something I would say we often don't talk about as much, but it's also important. There are also a lot of interesting questions and opportunities here. That was a big long introduction. So I'm going to talk a little bit about the mathematics of finance. Like, so, and what does math have to do with it, right? And I'm going to give a very brief, and this, I think, I'm going to spend a little less time on some of these slides I'll highlight a little bit more some of the sources. How many of you, I can ask, how many of you have thought about, have done any sort of math of finance? So, at a third, how many of you are like, oh my God, no way, no, never before. Okay, so we're a minority, and then some in between, right? Like you get the credit card offer and you read the fine print, right? Some of which is what we would call regulatory boilerplate. When you read the fine print, think about that. What's really useful and what's not, right? Again, that's another place to keep your critical eye on the world and how it works. What information is really important? It's hard to read, but to some extent, it's hard to make oneself read it sometimes because it's almost printed out like you shouldn't. But what I hope you'll take away is some sparks of curiosity to look in between some of that fine print. So the first part of math is like, generally we think of money as just a fixed amount, right? It's a stable store of value, right? But when the first thing we do in mathematical finance is that we think of money as a function of money today and money tomorrow. We have to think of as two separate things. I have it today, and whatever I do to get from today to tomorrow is a decision, right? We tend to think of it as sort of a store, and that is from a mathematical, from a formalism point of view, it's trivial. From a conceptual point of view, it can be less. So. So we tend to think of a reference interest rate that allows us to, often in the simplest frameworks called present value analysis, I need to decide if I want money today or money tomorrow, and I'll think of an interest rate. What interest rate? If I have money today and I'm not going to use it and I can put it in a bank, I could get more money back tomorrow. I could get interest, right? Or maybe I have to decide that I don't have money and I have to, if I want to spend money today, I'd have to go borrow it. And then I'll have to pay back more tomorrow. Should the interest rate be where I can save and where I can borrow? Very good question. Depends on the application context you're looking at. There's not necessarily a right answer. But when we think about, well, oftentimes we'll say, we'll assume it's one or the other, and those two kind of probably aren't going to be too radically far apart, although in reality we might find, you know, that they are. That's a real decision. But again, if we think about just introducing you look at a math finance book, and I'm going to put forth some of these slides, right? I can then use a present value using an interest rate convention and think about the money I get back in the future, and then 1 over 1 plus R. I skipped the formula, but here we are. I can compare potentially cash flows happening over time with a present value by present valuing the cash flows. So I have a today cost versus a future stream of cash flows, and in this case, I used a 10% interest rate. And so I could make a decision on which I'd rather do if I really know what interest rate is relevant to me. So present value is one of these core concepts I have up here. A good reference that's used at, it's a corporate finance textbook. It's used at a lot of big business schools. Recommend flipping through something like this. It's going to be very accessible, lots about how things work. So how to calculate present value, chapter 2 of a corporate finance book. But of course, we never know exactly if we're promised $100 a year. If we're going to get $100 a year, say, from an employment opportunity, and let's say the $350 was, I had to pay for a course to learn a new skill, and I'm trying to decide, should I pay $350 today to get a new skill that will allow me to earn more in the future? Well, I don't really know if I'm going to earn more in the future. I always will tend to have uncertainty. So generally, we could say we're storing value, but we never quite know how much value we're storing. So in fact, we don't have a fixed interest rate that gets money from today to tomorrow. Really, when we think about money in the future, we're thinking about probability distributions. So when we talk about a lot of the math of finance, we're thinking about potentially stochastic calculus or stochastic optimization, something with probability distributions and uncertainty. And we'll often think about what our expected value is, and some notion of how much better we could do and some notion of how much worse we could do. and think about, depending on our relationship to this underlying income, where we might really care about something other than an expectation of the distribution of future money. Say if I'm lending money and I don't know what the income of the borrower, I don't know what the income of the borrower will be. If their income, they have a really great income, they end up earning much more than we thought when we initiated the loan, I will still only get the fixed amount I was promised back. But if it comes out much worse, right, I may not get paid back at all. So I have downside potentially, but I will have limited upside. So we tend to start thinking a lot about what the particular shapes of those distributions are and lots of attributes of the distributions. And then oftentimes we'll often think about worst case outcomes to some extent, some notion of risk, some notion of what if things go wrong, right? Even if we're just talking about our own earnings, or we're talking about, say, Institute for Advanced Study that wants to use its endowment to keep its programming going. It needs to say where they're making investments. Those investments may go up or down. What will they be able to maintain their activities in some worst case scenario, right? They may say, how much risk, how much uncertainty are we willing to absorb because of, and we might think about the percentage chance that we won't have enough to meet our goals, right? And so in math finance, they're often focusing on sometimes on just the standard deviation of the distribution of future cash flows or values, and sometimes on tails, and sometimes on the conditional value of the tails, especially if you're in insurance, right? Think about property and casualty insurance. You're insuring buildings, you're insuring floods. You can have very spiky outcomes because of huge events like the floods in California. So you're often thinking about these attributes of the different attributes of distributions of future values. And then, I just had to put in a picture of a beach because we care about outcomes, right? And one of the classic examples of how we talk about outcomes in finance is to think about a theoretical business at a beach that could make a choice between different products. Do you sell rain umbrellas if you have limited room in your store? Do you sell beach balls and rain umbrellas, or beach balls and sun umbrellas? Right, I could expect, actually, next time I'm going to change the slide, right? With beach balls or rain umbrellas, the business would make money rain or shine. With beach balls and sun umbrellas, you only make money if it's sunny, potentially. And this is not the best illustration of those outcomes, right? So diversification is it's a very simple example of diversification, and a lot of what so there's the idea of diversification. What does that mean? What if I'm investing on the Institute for Advanced Study? I want to maintain my ability to continue supporting these amazing buildings and equipment in years to come. And I want to earn a return, and I want to make sure if one of the assets I invest in goes down, others will hopefully go up. I want to find uncorrelated assets to diversify. And this is a major question that underlies a lot of what goes on in a lot of investing, is this search for, and this is a simple illustration of a correlation matrix where red it represents perfect correlation and green represents negative correlations, and correlations are remarkably non-stationary. So this would be a simple analysis based on a historical time series of looking at prices of different assets that are traded in markets, weekly. But there is this idea that diversification matters. What are we doing? Are we taking our portfolio meant to last us for our future, maybe for our retirements, maybe for the life of our universities, our institutions, and are we putting them all of our proverbial eggs in one basket, or are we really spreading them out, and how are we to know? And then given another core toolkit that we're trying to use is, how do we make the best decision anyway? How do we want to trade off our risk and our potential upsides? We have to think about our feasible sets, the choices that are available in a given context to allocate between different assets. What our objective function is. Is it just some notion of an expected outcome? Is it some notion of a utility, which is a convolution of some preference for outcomes with our underlying distribution of possible outcomes? And what are we constrained by? Do we want to say, I'm willing to take a lot of risks, but under no circumstances do I want my retirement income to fall below some amount. Under no circumstances do I want to risk that I'm not going to be able to afford college tuition for my child, right? If you're investing, putting money aside for education. And they're also, so themselves can be very complex, right? If I'm looking at something like a tail side of a distribution, you get into very interesting and subtle optimization problems. And then you also run into discrete nature of choices. I get to invest certain amounts and not others. I get to invest it in a discrete number of shares. And so you end up in finance, in investment allocation, or I'm going to lend to you, you're going to ask me for a loan, and I might be able to say how much, but I might only be able to say yes or no, right? Very discrete choices. So some really, again, subtle and fascinating distinctions of problems going from, oh, maybe it's not that hard, to really hard as you're looking over discrete numbers of choices, right? And there's also another point that a lot of these decisions aren't one point in time. I'm really making a decision. We talk about, like, every day we're making decisions. What are we going to do tomorrow? When are we going to consider? When will we rebalance our portfolios? We'll have income, happening over time. So we often, another distinction is, if you pick up a math finance book, there are different classic math finance books that will cover in continuous time versus discrete time. Very similar materials, but kind of different formalisms to come together. Sort of different formalisms can dominate, and just something, again, to be aware of. So giving you a little bit of, like, the big landscape with a little bit of, I know, you get your hand on a book as a mathematician, what questions you should be answering to sort of understand where this book fits into the big landscape. So a classic example, sort of the canonical example in finance of an optimization problem was formulated by a man named Markowitz in 1952. And the idea is to think about the return of an asset, sort of the final value of the asset over its initial, the variances of those distributions of return and covariances. And we think about an expected optimizing for a minimum uncertainty, looked at as sort of the variance, constrained by having only a finite amount to allocate, and constrained by wanting a certain return. So you can think, shouldn't I be saying I want to have a certain risk tolerance, I want to maximize the return, and you get a similar problem, solution out. But this is the sort of the classic formulation of a single period finance optimization model. It's a lovely convex problem, and it's powerful and used widely because it's so tractable, not necessarily because it's so relevant. Because rarely does anyone really care about, rarely are these distributions really that symmetric. Rarely do we really care about the standard deviation. We usually really care about, like, some worst case and wanting to avoid the worst case. But this is the classic. So good reference point. And then we have things that are called efficient frontiers that often say, well, for a given level of risk, how much return could we get? So the notion of efficiency comes up within, again, a given risk tolerance. What is my return, or I could say, given I'm on a certain return, right, what's the least risk I need to take to get that return? And I'm part of an investment committee that's allocating on behalf of a foundation that promotes small business growth. And we are thinking actively about this. We're looking at expected return forecasts, we're looking at covariances, and we're making portfolio allocation decisions. And sometimes we will change what we do because we want to get to, for a given level of return, and see that we can diversify, right? Or we decide we're willing to take more risk and make a specific allocation decision. So a lot of this is using a framework, what we would call sort of a structural model. I'm thinking in terms of some distribution, and I would think, and I've shown you all these pictures of Gaussian, sort of renderings of Gaussian distributions. Why? Because they're the easiest to render and find, and they're, we think about a distribution, right? Central limit theorem, right? Of course, we think about a Gaussian, but there are lots of important predictions that are being made, and maybe we want to get to a decision, to an action based on observations from the past or things we know, without going through those figuring out the interim structure of our cash flows. We want to get to a decision, or simply sometimes I want to think of just about, not about what action I'm going to have, but just a prediction of a covariance matrix. And inside larger asset managers, you'll find a lot of people who are thinking just about those covariance problems, which have also a lot of beautiful and subtle math behind them. Is it really a covariance, or is it random, right? Sort of intersection of cool stuff, random matrix theory, right? Like rich and cool. I don't know if I'm doing a good enough problem of showing how much neat, rich math there is just adjacent to some of these questions and where they fit in. But there's a lot, but then there's also a lot that can be done with with the machine learning tools, or recent, right? And the last couple of decades has been so promising for algorithms that can go directly to decisions without thinking about interim structural assumptions. And those are extremely powerful in finance. They're extremely powerful in almost every sector. So this is just an overview of sectors, an overview of a bunch of prediction and decision models, fraud for credit cards, huge volumes every day. Every time we pay using an electronic network, if someone else is providing us credit for that, they'll often provide us with insurance. If it turns out it's not us using this for a legitimate decision, it's something illegitimate. So what patterns does that fraud follow? Do I care if in consumer lending, can you use bank account activity to forecast future income or capacity to repay and history of repayment? So all sorts of new types of data allowing decisions to be made about financial decisions. Generally, you'll see often a notion of alternative data used when it's not the sort of data that was used historically in a given sector. It's a term of art, but as in finance, as in so many other realms that we interact with, these tools and notions of inference are almost everywhere, and almost every problem we've talked about will have a rich number of inference problems under its hood. And I realize I am but predictions are really hard in finance everywhere, right? There's a lot of non-stationarity. So many of us, or some of us in the audience, will remember the financial crisis, and some of you who are, may remember it from your youth and remember it impacting your parents. Correlations radically changed in the financial crisis. And a lot of institutions that thought they were diversified in fact, were not diversified. And you got headlines, right, with formulas in them, which I think is kind of cool. It's like, when does math meet the headlines? So here's one from Wired magazine in 2009. What are the data challenges? What do you do with bias? If you've had historically excluded communities and all of a sudden you want to include them, what sort of data incrementally should you need to have to effectively understand those communities and that behavior. And then what happens in a model where your data captures only a small part of relevant information? What does it mean to have visibility into that model or to be able to explain what's happening and why? So I have a few picture excerpts and some sources from some, again, some places where sort of math meets the headlines, and a paper by some computer scientists from MIT that I think does a great job of formalizing these questions of what bias means. And it's really interesting in these contexts to think about statistical bias, that somehow sample data is non-representative, and bias in other senses, systematic exclusion, making decisions for causally unrelated reasons that are harmful. And when you think about those two types, there are a lot of similarities in dealing with those two sets of challenges, and a lot of really interesting work being done at this intersection of socio-technical systems and machine learning. And I can provide more on these sources later. But again, it's another place where I think finance suggests a lot of really rich and interesting problems. So careers, all right, and this one, I'd love to have a lot of time for questions. So I talked a little about where I went. This is a little bit more, it's like a windy path. I started out at Lehman Brothers, which is a firm that went down in the crisis, right? And it did not survive the financial crisis. And then I went to Goldman Sachs, and then have had these subsequent chapters that bring me back to Princeton. And like, how did I get to, just briefly, like, how did I get to finance? Right? Because I actually came when I was at Princeton to some seminars on math finance that were held here at the Institute, maybe even in this very room. So I was in your seat. It does look like the upholstery is quite as well, right? But why did I end up in finance? Because finance was actively recruiting at the time. So they were so there was an understanding in finance that the sorts of technical training that all of us have in capacities and interests would be relevant. And that certainly was part of why it came to my attention, right? And indeed it was relevant, right? But you need to find sort of specific jobs. So sort of math and engineering were becoming obviously more important. And there were interesting technical challenges, again, that I learned about in coming to lectures here and reading books and through peers. And then I also felt like, wow, this is practical, this is useful. There was a notion that I could do something, it was sort of tempting where it called to me a little bit, because it seemed that it was going to give me some insight into practical knowledge. I wasn't sure that that's where I wanted to stay, but I felt like I was going to learn things that were interesting, that gave me that sort of satisfaction of problem solving, exposure to new technical fields, and also practical, relevant, like gave me some insight, gave me some know-how that would be useful. And why did I go to an investment bank? Well, you're an investment banker in the middle of the markets. I got to see lots of those individual types of companies and what they were doing. So it was just a nice way to explore. I did end up staying, but I moved around a lot more than many careers. I worked as a quant, as a data scientist. We didn't call it data science then, but it was kind of the equivalent as a data scientist, right? I worked in with lots of different types of end service providers. Municipalities also borrow, right, money to fund infrastructure projects. So I spent some time working with municipalities, with investors, with insurance companies, across a lot of different individual types of financial services or quote unquote products. So that's, so I did end up continually needing to read new books and learn about new formulations of problems. And so I enjoyed the variety that I found. And I've enjoyed coming back and working in Orphe and seeing academic approaches to these practical, to the problems that I experienced in industry. So I would say there are close adjacencies in the industry with many different fields, economics, of course, operations research, financial engineering, right, Orphe, woo! data science, statistics, and machine learning, computer science, and applied math. There are many subspecialties, many journals, many flavors of journals, many departments you'll find people working on finance problems. And you may or may not find some of those call to you, right? But choose your field and look around, right? If you want to go in that direction, and you'll see a lot of finance. And so this is just a little, some things that I read, books I read about options, futures, and derivatives. That was very active. I read that Principles of Corporate Finance book, a way distant edition, because I just wanted to know what the world was. There's a book that some folks use at Princeton called Investment Science, which is also a nice introduction, used in some Orphe courses. And then I've done some work with collaborators at Princeton on investing and machine learning and finance and data and consumer lending, including a class that I got to teach with Dan, who's in the audience. And most recently, I've been working with startups, and that includes Funding You, which I've talked about, with Stratify, which is an interpretable AI company that uses a toolkit called probabilistic rule engines, which is the intersection of hard decision rules, logic rules, probabilistic logic. And that's an approach that's very near and dear to and very much facilitated by some novel database technology. And I'm also involved with a company that has a lot of actually OR talent in it. So I spend my time thinking about both products, what their products do and how, and then also how the companies are financed, and working with people starting new companies, relating. Oftentimes financial services are very important customers of theirs. For some of them, obviously, this is a financial services company. This is a database company that's serving financial services, doing a lot with graph algorithms, sort of the intersect, as well as a lot of facilitating stochastic programming. So a nice intersection for someone with interests in OR. What will your career in finance potentially be? In finance, with finance, you can think about the different sectors. You can know there are an outsized numbers of opportunities in markets because of that notion of scale and the role of markets as intermediaries. And you can think about end services. The demands of end consumers are diverse, and they're unevenly met in the world. And so thinking critically about where the mechanism of markets is meeting end needs or not can give you also insights in, as a consumer, as a citizen, and potentially as someone who wants to work with a smaller finance company in some capacity, right? Or as a customer, as an advisor, as a career, to think about how to really change and evolve. And innovation can change and fill gaps. It's hard to move a system that's based on large consensus, right? Where we're each a node in a very complex graph, but new companies are an exciting place for that to happen. So why finance? What would I say? It certainly impacts all of us individually and collectively. It's been very satisfying to be able to see many aspects of this industry and to think about its role in our world. Math is essential. There are many rich, cool problems, and there are a lot of decisions happening every day, and a lot of them, there's room to make those processes better. And you guys have the technology, you have the foundational training that will open up the potential for a lot of these problems and the potential to make a lot of new solutions. So that is what I would hope to inspire you to do today.
Are there any questions?
So I would like to go back to the slide that you were talking about bias, and you had the statement on there that bias is mathematically inevitable.
Oh yes, that was, oh yeah, that talk about, I was actually thinking about, I'm like going to include that because that is it sort of, that's a sample of,
Yeah.
talk about a biased sample. I mean, in a few ways, right? This for a moment, my last 5 minutes, yes. And
I guess I don't have a specific question. I just wanted to know what your thoughts were on how mathematics can also help reveal bias and how we as mathematicians can become more aware of bias that exists in like applied settings.
Yeah. So look, I think that this headline, and I'm glad to attract attention to it. So I always am attracted to places where things that are sort of obvious to the, or that are experienced, that we experience in our everyday lives intersect with ways that we can understand pattern using mathematical formalism. And this excerpt is from a headline in a publication called ProPublica that came out in 2016, and it was a review of a criminal risk scoring system provided by a private company. And a lot of the issues with, again, and I use the word socio-technical because that is a sort of an academic term used in a community of scholars that looks at systems like decisioning, loan decisioning, service provision decisioning, trying to think about them both as technical systems mathematically and as socially impactful systems. So this ProPublica article in 2016 was an analysis of based on publicly disclosed data to try to back out what the risk score was. And it's a very simple, relatively setup where you see that there can be many different definitions of what it means to define a fair algorithm. And that there is a paper, but there are a couple of papers, mathematical papers. So you had a public interest journalist claiming that this decision algorithm was unfair, holding up one set of formal metrics. And then you have the company responding saying, no, it is, holding up another set of metrics. And then you had mathematicians and theoretical computer scientists say both of these things are true. And in fact, these definitions can be incompatible. So essentially what happens is when you have historical correlations between what we think of as sort of class membership and sort of behaviors that we're seeing, right? So you have in lending, historical lack of access to credit by minority communities. And then we want to say, we want to extend credit to historical communities, but you have less wealthy communities. So you're going to see a correlation between group class membership and what you would think of as creditworthiness. And so it's a really interesting series of papers where headlines led to new mathematical insights. And similarly, I think looking at the formula that killed Wall Street, the idea of a copula, of correlations, of using structural models, right, that were then incorrect. Again, a very different sense, but also important in terms of understanding sort of decisions and priors and where we make assumptions. Thus, some of the richest areas in these literatures, I think or some of the rich veins in these literatures, I should say, there are many, come in thinking about and formalizing where the gaps are between. So this idea, and this is what happens in the world where we're collecting data and then we're making decisions based on that data, but the decisions that we're making in turn impact the outcomes that we're going to see. And you end up, again, here with a lot of multi-period frameworks. Lots of interesting reading in those areas. And that's one of the reasons why I was interested in this, getting involved with Funding U's consumer lending business that was looking at an area in student lending where one could say, so many, like the world, like we're having issues that we have too many loans to students. And maybe a lot of those loans aren't being made responsibly. And there may be in the interests of the institutions providing less valuable education. Why should we think about working with an organization that's making car loans to students, you say, well, let's look at a sector that isn't being well served. People in the middle of college that might drop out, that need responsible incremental lending, that don't have family wealth, someone to co-sign for them. What does it mean to be able to responsibly provide capital into that space? It requires a lot of conditioning, a lot of thinking about causal relationships that might mean that part of your data where you're seeing trends is in fact looking at only sort of a subset or lens. So that would be another, I think consumer lending provides a lot of interesting examples as well.
Yeah, I have a follow-up question. It's also related to the term of bias. So it's tracking those giant covariance matrices over time and looking at the resulting probability distribution. And then looking at the set of norms that you have. Would that also help you determine the definition of bias that you set in the statistics?
So oftentimes in the realms where we're tracking those big covariance matrices, it's sort of a background. We're already looking inside a world of data. We're already looking inside a world of instruments where we have a lot of frequent exchanges. Right, so I'm making a decision to buy or sell something, but it's to buy an investment, but it's an investment that lots of individuals are making decisions to buy and sell. And so we would say there's a market for that, and there's a price I can observe in that market. And already we're sort of narrowing down the lens, right? We're already sort of inside. Now inside those histories of things that are getting exchanged a lot, right? That are happening at large volumes, right? There's a lot of rich inference questions, a lot of rich statistics questions, a lot of issues about covariance, about regimes, interesting sort of underlying, are there hidden Markov models? We're in potentially a recession now. So that means correlations might look very different than they did. Oh, I guess I should go back. Previously when we weren't, right? So there's a lot of sort of interesting approaches one can bring to think about those price histories. There's also a lot of details sometimes. Are these all the same time of day? Look, I have something in the UK. If we look up closely, something in Asia, those markets might not even, right? Or something in the US, the markets might not even be open at the same time. What does it mean to look at a covariance between two things, between two markets, when the marketplaces aren't open at the same time? How do we do that? This was probably done pretty naively, but again, when you look up more closely to what's happening inside your data, there are lots of questions getting asked, like lots of interesting modeling that can be done, sometimes using, again, varieties of approaches, sometimes more parametrically inspired. And there's a lot of really interesting sort of Bayesian statistics, and then a lot of really interesting stuff happening using the less structure-driven non-parametric approaches as well.
Great. So I think maybe we should continue this conversation over lunch. So thank you so much for your talk.